Hi everyone, Yuchen from Genuine Impact, the app that makes investment research simple. I'm back again with another video this week. I want to talk about the risk of recession this week, as many of the usual signs of a recession are now in place. Central banks are raising interest rates and draining excess liquidity from the market. Fiscal support from the pandemic response is being reversed. A commodity supply shock is pushing the prices up and therefore imposing an implicit tax on consumers. And the economic growth is indeed slowing down. And many of the usual warning signs of a recession are flashing as well. Equity market has tumbled. The yield curve has begun to invert in the US. Credit spread has widened. Consumer sentiment has weakened. So clearly, the risk of recession is in the coming months has risen. But whether those factors has made the recession a certainty is another question in its entirety, which I don't believe to be the case. Some degree of deceleration from the blistering pace of the growth of 2021 was, inevitable, and this was always going to be magnified by the unwind of monetary and fiscal support put in place during the pandemic. A slowdown this year and next year would likely to be unavoidable in any cases. Central banks are indeed raising interest rates. They are starting to from a very low level, and real rates remain negative and probably will be for a while. Higher inflation are likely to constrain business activities for quite some time, but corporates are generally cash rich. The fiscal support from the pandemic payments to consumer has helped to rebuild household saving, which will support consumer going forward, offsetting the fiscal headwind, i.e. tax increases. The commodity price shock is likely to partially abate in the coming month. Indeed, there are many signs Russia has substantially rerouted cruise ships into India and markets, leaving the global supply chain and the distribution more or less unchanged. Labor market tightness probably reflects some of extent structural changes in the workforce in the new normal post-pandemic. And finally, those blistering pace increase are likely to moderate in the coming months, as many central banks and economists has suggested already. So what about those recessionary warnings? Equity have fallen so far this year, with MSCI All Country World Index down as much as 14% from the peak at one point, but those losses has already been partially recouped. More of a warning expectation thus has been largely unshaken. The headline has not yet translated into bottom line and fundamentals of businesses. And as for the yield curve, sections of the yield curve that has started to invert, particularly the 2-year to the 10-year, is not the most reliable indicator of the recession. Rather, the 3-year to 3 months 10-year, which is more reliable indicator, remain upward sloping, and those investable will uphold much longer period to taken as the reliable signs of recession. The rise in the credit spread still have them with a historical range and normality, and given the corporate cash level and the low level of borrowing costs in the absolute terms, there are few signs of a distress. And finally, the decline in consumer sentiment will need to be translated into belt tightening in order to have economic impact, which so far this appears not to be happening. It is important to note that a little bit of deflation can be very bad, whilst a little bit of inflation actually can be seen as something positive. When deflation strikes, a consumer or a customer benefits from not spending money with the passage of time. It buys more as prices fall. With inflation, however, companies and consumers are motivated to spend, as otherwise money loses value with the passage of time. This spending is the engine of the economic activity. Of course, if the inflation gets too high, there is unprotected activity associated with protecting the value of money. But we're still very far from that level of inflation, and the central banks are already taking actions. To sum up, it isn't clear that on the verge of recession. For investors, that suggests we're taking advantage of recent dips in the markets and add names with strong fundamentals and quality, particularly given the severe pain in the bond market. There are still no good alternative to equity in the longer term. Hope you enjoyed this week's update, and let me know if there are any in the comments what you'd like me to cover in the future, and hope you have a good week.